Does everyone hear me okay? Can everyone hear me okay?
Yes.
Very good. So let's get started. We'd like to welcome you to our monthly IBD Meetup monthly overview. My name is Roy Maddox. Wes and I are hosts and the facilitators of this monthly webinar. This meetup is sponsored by Investors Business Daily. Our meetup group is one of the largest in the country. I've been employing can slim tactics for over 34 years, over many different market cycles, and we'll share with you tonight much and many of those tactics so that you might benefit from them, hopefully. If you're not on our email list and you would like to receive our comments, please respond in the chat and provide your email information. This group is a private meetup group of almost 2,000 investors who know with 100% certainty that the ability to change their financial lives is possible by identifying and purchasing true market leaders. Many of us have done so. We're all like-minded. We don't believe in a buy and hope strategy. We believe that there are times that you should be out of the market and there are times that you should be in the market. Certainly 2000 to 2002 and 2007 to 2009 during the great financial crisis were times that it would have paid to be totally out of the market. So we like to be fully invested when the market trend is in our favor and reduce our exposure when the market is in a downtrend. All of us tonight aim to educate and connect each other and connect investors from this meetup group to an active online community and vibrant meetup group. Most of the focus tonight will be from concepts that we all have learned and employed from William O'Neill that are featured in his book, How to Make Money in Stocks. I was fortunate to meet William O'Neill in 1988 at a seminar with his protege, David Ryan. And really that began my lifelong journey of being passionate and learning more and more and more about the market. And I've continued to do that over the last 34 years. So tonight, we hope that we'll inspire you. Tonight, we hope that you'll learn something. It'll be a venue where we can share comments to each other. And we hopefully that it will provide a great educational background. Tonight's agenda will be covered in two different sessions. In the first session, we'll be taking you through our slide presentation. And the second part of the presentation will be talking about individual stocks. If you're a novice investor and here for the first time, don't fret. Many of us, many of the people on the meetup group tonight on the call were novice investors at one time as well. Some of the most successful investors have really no formal training, but because of their passion and their desire to learn, they have achieved great returns in the past. The presentation tonight will be titled, do you guys see me okay?
Yeah.
Yes, sir.
Okay, good. Okay, the presentation tonight will be titled Temperament, Temptation, and Time. Temperament has to do with mindset. And that has to do with what personality you've been born with. These are innate qualities you must harness because they can be influenced by the media, cultures, your upbringing, your experiences, and your natural desires. So it's very important that you have the proper mindset. Temptation is really being able to take the needle out. It's controlling your emotions, being patient, be incremental in your exposure, not plunging in. We added 4 stocks today and now have 5% exposure. In the second half, we'll be talking about many of those stocks and what we think are potential new market leaders. So you have to understand that temptation is always something that you have to deal with. And then time. You have to understand that it takes time for a proper trend to birth, grow, and mature. It takes time for the next true market leader to reveal itself. It takes time for leadership to expand. It takes time for volatility to calm down. So work on it. Usually there are many fits and starts in a bear market, such as the bear market that we're going through tonight. A little bit about our Investors Business Daily Charlotte Meetup group. You can find us online if you'll just Google us. And of course, our disclaimer, this presentation is designed for informational purposes only. None of the stocks that we discussed tonight purport to be recommendations. So be sure and do your own research accordingly. CAN-SLIM, we're all familiar with the CAN-SLIM acronym. We won't cover this in detail tonight because almost everyone on the call is familiar with IBD's methodology that's featured in the book, How to Make Money in Stocks. We will talk a little bit about having a process, and we have a process where we're considering the technical analysis aspect of the market, the fundamental analysis of the market, and macro analysis. We consider these three stools in terms of achieving our process. We're looking at, in the technical analysis part of the equation, we're looking at various technical indicators, the MACD, price phase, RSI, stochastics. Many of these are found in many different books that relate to technical analysis. We think the most important concept in technical analysis is just simply looking at the trend, and we identify the short-term trend occurs in an uptrend when the 10-day exponential moving average is greater than the 21-day moving average. We currently experienced a follow-through day Friday on 10/21, in which the S&P was up 2.38% on 28% higher volume, and that initiated a confirmed short-term rally. However, the 10-day crossing the 21-day, it's only been 3 days since that's happened in the QQQ, the NASDAQ 100 index. We consider the intermediate term index to be in an intermediate term uptrend when the 21-day is above the 50-day, and we currently have that on the S&P 500 currently. But we're bumping up above the we're bumping up right to the 30-week moving average. We won't be into a very vigorous bull market rally until we close at least 2 weeks above the 30-week moving average. And we've got a chart that we'll go over tonight as well to show you what that looks like. We'll also go over some charts to show you what the breadth is looking like. When the percentage of stocks are above their 50-day moving average, that's when that exceeds over 50, then the market is turning into a healthy, well-defined, broad market. And when the percentage of stocks are above their 200-day moving average, approach 50 to 60%, that ensures that we're in a healthy market as well. And currently, those breadth indicators are showing that we got a decent market going. However, we don't have an expansion in new highs versus new lows yet. When you talk about sentiment, we monitor what the National Association of Active Investment Managers are exposed to. Currently, I believe that's 53%. And we look at indicators such as the VIX or the put-call ratio. We also consider the high yield index option adjusted spread to understand the economic conditions. and how tight the bond market is, or how easy it is in terms of achieving financing. And we look at ratio analysis to observe where the money is going and where the rotation is taking place. Is the money going into small caps or large caps, or stocks outperforming treasuries? Is money going into growth stocks or value stocks? We think those things are important. And of course, in CanSlim is predicated primarily of being able to achieve great fundamental analysis. Bill O'Neill, I heard him say many, many times that his best stocks were the ones not that looked the best technically, but the ones that had the best fundamental numbers. If you find a stock that's expanding, that's got triple-digit earnings, triple-digit revenue growth, great margins with a big market ahead of it, and a big runway, many times these turn into the true market leaders. So that's one of the things that you want to focus on. Macro economic analysis. This is the third part of the step, and we are subscribed to Hedge Eye Research for our macroeconomic analysis overview. Think of this as your North Star. So it's important to know from a macro perspective, which stocks do best during different market cycles. Keith McCullough of Hedge Eye, his models show that we're in a quad 4 market in which GDP is declining and inflation is declining and the Fed is tightening into this cycle. This is one of the poorest market environments that you can be in on a macro environment. We'll talk about the market being in a recession or not, which is a macro economic variable. We think that's very, very important in terms of considering, do we have more downside or not based on what the macroeconomic outlook is? And we think it's important to consider that and having a North Star on the economy. It all comes down to whether or not we're going to be in a recession or not. If we're not in a recession, we have bottomed. However, if we have a profit downfall and companies' earnings start to get slashed, then we will be in a recession. And some of the charts tonight, they'll show you that there's a high probability that we're in a recession now, or we will be shortly. And if we're in a recession, we just haven't had the downside that's typically happened in bear markets that have led to a recession. So the market, I think, currently is down about 17, 18, 19% on the S&P, and probably down right under 30% on the NASDAQ. So if we go into a recession and we have a profit lowering numbers, then Wall Street's going to have to sharpen their pencil and lower their numbers and lower their estimates. We think there's a high probability that that's going to happen before it's over. So while we're in a current market uptrend currently, it's important to not plunge in. It's important to wait until all the setups are there, and we have plenty of time left if this turns in, this confirmed rally that we're in, if it turns into a long-term bull market. And with that, let me turn it over to Wes. And Wes is going to take you through the rest of the slide deck, and then I'll take charge on the second half of the program where we will look at all the individual stocks. Wes?
Yeah, thanks. Now I'll take over with the screen. If you can pause that yourself.
How's that, Wes?
You're still sharing. Thank you.
Okay.
There we are. Yeah, so like we were talking about, I think like he was just talking about, if the question kind of is if we're going into a recession or are in one right now. The Dow Jones, I have this chart here with, comparing from Ned Davis Research, comparing bear markets in the Dow Jones versus like all the other bear markets. And so the lowest it went was 22%. And if the bear market's not over, it's been about 218 days. So, if we can somehow get out of this and the economic situation doesn't worsen, we're kind of right there at an average bear with no recession. But I think, our view is still not positive in that regard, but still we'll have to obviously wait and see how it all plays out. And okay, I looked into this on that big up day that we had in the NASDAQ, or the entire market. I guess it was just a couple days ago, when I saw the NASDAQ was going to close up at least 6%. So at 3 o'clock, I started looking. I was like, okay, this is a big day. I wonder how many big days like this there have been. And so when I filtered the daily changes and over the last 50 or 60 years, I noticed that all these days of greater than 6%, first of all, there were a lot of them, and they all clustered around 3 periods. Really 1987, there was just one. 1998, that was a brief bear market where there was another one. And then of course the dot-com bubble, the great financial crisis, and then 2020 were the other 3 periods where we saw these massive moves. So I just thought that was extremely interesting, right? You can get a ton of FOMO. You say, why wasn't I fully invested on that day, right? And how could we have really known? We sort of, the CPI was not necessarily a shock to us, the number. We expect it to come down over time. So you kind of wonder what drives that huge rally. Why was everyone so unprepared? But here's a look at the chart. I went through and marked these days of the NASDAQ from 2000 to 2002. So these are all the days. It's not that clear, right? But the point is there's a ton of them, right? And this is a historically bad period for the market. And, that's the point we're trying to make is, when markets are this volatile, it's not necessarily a good thing, right? It doesn't really mean, hey, it's a powerful follow through day. Hence, we should all be fully invested on the powerful follow through day. This happened 14 times in this 3-year period. And notice the last one here in May of 2002 when it was up 6% or so, whatever it was. And that still didn't even mark the bottom. So if you thought every one of these was your opportunity to call the bottom, you would have been wrong every time during this bubble. And then so similarly, we saw these big moves in 08 and 09. We marked them here. The first 4, those were all false signals to get fully invested. And then finally, your last 2, number 5 and number 6, actually did kind of mark a bottom there. That one in particular, very tiny. So, maybe this is the one where first one's the charm, but we'll see. Because, for now, this is where we're at. We've had some pretty good follow through, right, the last 3 days as well. But one thing we looked at, and you guys probably all noticed if you're watching these things, is it was very index heavy, right? So it's a lot of mega cap, Apple and Amazon and Google and Tesla all bouncing, all bouncing 5-6% on this day. But then there were huge moves from a lot of the beaten down names. So we just pulled in 12 of them here to give you an example. This is a weekly chart. So these numbers like this up 9.7% in the week for AppLovin. This was probably double that on that day, right? On the I forget which day. Was it the Thursday of last week?
Yeah, I believe so, Wes.
Right, the 10th. Yeah, the 10th. So that was Thursday. So, what was a huge driver was all these things. Carvana, up 14% last week. But on that day up 30%. So all these things were up huge double digits. And you wonder, why, right? Does 7.7% inflation mean the bottom's in for these? I don't know, but that's why we haven't. The leaders are not what we have seen expand from here, right? We're still looking for those, and we're still trying to buy the cream of the crop, right? We're not trying to buy these beaten down names. We're still looking for those stocks that are making new highs, but they have not taken off with the indexes at this point.
And let me point out, Wes, that many of you and we have the same FOMO possibility out there. It's just we've been through this for so long, and you can go back and look at these beaten up stocks, and normally hit what happens at market bottoms. The stocks that are down 70, 80, 90%, and we consider that really subpar merchandise. Those do bounce. But look at this downtrend where for all these stocks, if you would have guessed wrong, you would have been chopped up. And but at the ultimate bottom, that's what happens with the faulty merchandise until you make the transition, until you find out who the new leadership is going to be. Many of these are going to flame out, and they'll probably go sideways. It will take them years once you have this short-term bounce. So you don't want to get stuck. You don't want to have a portfolio of dogs that you get stuck in while the new leadership emerges.
Right. Yeah, and so we just to highlight the CPI again. We talked about this on Thursday when they reported it. So we're clearly off the high. It looks like CPI is peaking. We kind of agree with that. CPI coming down, as it should, as the Fed slams the brakes on the economy. And so here's what we're kind of basing our view on the CPI. We're utilizing Hedge Eye Research's forecast for GDP and CPI or inflation. And so one of the things where they're different than consensus at this point in time is just the stickiness of inflation. We'll see, but one of those things that takes just a long time to flow through is the shelter component, for instance. I think if things do come in quicker than they're forecasting, then I think that signals more pain than probably they would expect. But we'd expect the things that are going to be impacted first are those sort of those durable consumer goods. Very capital intensive, like cars and houses would be the first things that start declining in price. And so with that, following that report, and I think some comments from Brainerd this week or maybe yesterday or Friday, the markets are now pricing in a 50 basis point rate hike in December. So I think last month we'll actually take a look at this, or just in the recent past, this was a much higher percentage, right? It was people were expecting 75 basis points following Powell's comments, because he was saying it's extremely premature to talk about slowing the pace. But since then, I guess the CPI, I think the market thinks that we might only do 50. And so I created this new chart. I've showed something sort of like this in the prior meetings, but I thought this was kind of interesting to show you the path of Fed funds at different points in time. So clearly big jump from 3 months ago. From just a month ago, though, the things that have changed here is lower in the near term, but then slightly elevated for a longer period of time. There's not a whole lot of change further out, but I guess following the CPI, following some comments from the Fed, they often speak to news outlets. There's now this somewhat slower trajectory to get us to that 5% or so Fed funds rate next year. Okay, and here, since we've been showing this all year too, just the rising expectations for December, that's flattened out here. It peaked a month ago, not like it's come down a ton since then, but the expectation now, we're as we know, is about 50 basis points for the next meeting. Okay, and this has really been key for markets. The treasury yields, we've seen the 3-month kind of just march higher, just because the Fed is going to be the #1 dictator of where that rate will go, right, on the short end of the curve. But we got this pretty massive pullback following that CPI report in treasury yields, right? That's in 60 basis or 50 basis points, whatever that, from I guess October, right? So that's largely been the story of the market. It's rates up, dollar up, market down, versus what we saw the last 2 weeks, is rates down, dollar down, markets up. So that correlation has continued to play out here very, very strongly.
Wes, let me point this out as well, that if we go into a recession, and you're going to see the market pivot, and like everyone right now, rates are coming down, so now they're buying quote long duration assets. But if we go into a profit recession, that's not going to be good for stocks, and it's going to be good for bonds. And so we think that bonds are very attractive here because the slowdown on the CPI. But again, if we have a profit recession, these bond rates are going to really fall, but that's going to be bad for stocks, ultimately, not good for stocks.
Yes. Okay. Yeah. Great point. Great point. And for now, it's just this immediate adjustment that seems to be taking place. Like you said, with the, buying longer dated assets. Okay. But, the story with the yield curve has not changed, right? This is a famous recession expectation indicator. We're still inverted quite a bit. Nothing has changed since over the last couple of months on this. And so if this is right, if this is right, like it has been historically, this is signaling that we will be in a recession. Yep. And we showed this chart just talking about how the bear market in equities has really been powering through this. This has been the issue, right? This rising rate environment is just not conducive for equities. And like we talked about, just the steep fall in rates in a very short amount of time, and the big jump in equities that we've seen in just a few days. And we also showed this chart last month as well. This is a 1970s period. The one thing I added here was just the grayed out period where the recession actually occurred. So kind of wanted to point this out. We've talked about how markets bottom in the middle of recessions. So this again happened here 6 months prior to the recession actually coming to an end. So of course we have to be flexible. We know the news is bad. We know if rates have peaked, rates peaked here and the bottom was shortly after. Maybe that is the case. It's kind of a confusing predicament that we're in, though, where the government says we're not in a recession, so that almost makes it worse for the market, because then maybe we're heading into one. It'd be much better if we were right in the middle of it right now, kind of. If you were hoping the market would bottom sooner rather than later, hopefully you could rip the Band-Aid off. But it's unclear here. But the point is, maybe a similar environment, obviously high inflation, maybe heading into a recession like this environment, and rates collapsing. But also notice this painful period, right, when rates peak and the market still kind of unwinds from here to from 70 to 61. So it's just that's why we're being careful adding exposure here. Okay, and last week too, we had an election, so we just wanted to throw this data in here for anyone that's interested. This is from the Stock Traders Almanac. And I think, the consensus was prior to the results was that it would be Democrat president, Republican Congress. Right, but then the final Senate count is 50-50. So then we have that split, House and Senate. So, not a bad environment. Didn't necessarily think the outcome was that important in this election, but it's nice. It is nice when they can't get anything done, just because I think the consistent rules of the game help people that actually want to make investments, right? Like the companies that want to make longer term investments. This is somewhat helpful. Okay, and so now a couple charts that we look at every month. Here's the S&P. Big rally off the lows. I think we're up 15% or so off the lows. That was that CPI report a month ago, and we're coming up to that 200-day, right? So this has been a quick rally. If it's hard to add exposure today, like as we were thinking, we could add index. We could, buy the indexes, right, just to get a little bit longer with less volatility, because the volatility has just been crazy. But if you think it's just going to come up to the 200-day or slightly above, that doesn't give you much more room, right? It gives you a couple percentage points more before you start thinking about more downside risk, right? And maybe another leg, just like it perfectly kissed the 200-day back in August, which was great. This overshot it, but that's what we're working with right here. And notice, go ahead.
Yeah, so it's important to notice the durability of the trend. There's no durability. This is a market that's been distribution dominant. And so, you're just getting pulled in with the crossovers occurring, where the trend's changing. And this has failed the last 5 times. So that's why you have to be very careful in the indexes in terms of adding major exposure right when the market's peaking.
Right. Yep. And you can see the relative strength here. I know we mentioned how the NASDAQ crossovers were happening like 2 days ago, 3 days ago. And, this happened a lot quicker. And we've just, it's not exactly where we're focusing our attention in these S&P names like healthcare and, consumer staples. We don't, we're not looking for that. We're looking for obviously things that are more concentrated in the NASDAQ.
And I think people were leaning the wrong way also, Wes, from that day, 1, 2, 3, 4, 5 days ago, where the market totally reversed on you. Yeah. And that was going into the CPI number right there. Yeah. And it looked like it was the beginning of the next leg down. And right. I think people were on the wrong side. And that's what happens when you get these powerful 6% moves, when people are on the wrong side for one reason or another.
Right. Yep. And so, okay, here's the Qs. Consistently been weaker. If you flip back and forth between the S&P and the Qs, you can just see how, this barely made it to the 200-day on this rally, didn't make it here. Now it's got a lot more room to run. And we know that the profit recession, I think, has become a lot more clear for some of these large cap names in the Qs, specifically Meta, horrible, right? Google, Microsoft, and Apple, really not great quarters at all. The advertising market, not great. I think I saw a Warner Media or something at a conference talking about how it's, advertising dollars are now near trough COVID lows even. So, that's drying up a lot of that advertising revenue. Okay, and the FFTY, kind of the names we like to fish in, has not participated, right? Has not participated at all in this latest rally. There's a lot of turnover, so it could be, it's a little bit dependent, right, on the 50 names that are in there, but interesting how much it's lagged in this very, very brief but strong rally. Okay, and the Nasdaq with the MACD, MACD is on a buy signal. Also, turned up here in October, kind of a positive divergence, or I guess it's a confirming, both with higher lows there.
And also, Wes, point out that the bad day there, right where we turned down. See,
Right
right
here?
there. Yeah, that day, guys, it would have been foolhardy to have any exposure going into that CPI number. And so, we were in 97 to 99% treasury bills going into the number, because that's how the meltdowns occur. The crashes come in deeply oversold markets, and then it's the last 10 days. It's the last 10 days that can really kill you. So we didn't feel like it was prudent to carry any exposure into that CPI number.
Right.
It was setting up for disaster.
Yep. And I remember having really no FOMO on that first day. It's kind of slowly builds over time, but not on that first day, because it just didn't, it was a risky decision. And all the things that we showed that bounced, there's no chance that we were talking about how there was no chance that we would ever have been in any of the garbage that bounced 30-40% in a day, on that day. And here's the RSI. We haven't hit really an oversold or overbought condition on this indicator at this point. So maybe there's more to go here. Maybe that 200 days is in play. Here's a closer look at the moving average crossovers that we tend to focus on. The 10-day being the green over the magenta line, and the 21-day. So that's kind of our short-term trend indicator. We're above the 50-day. 50 days flattening out. We still have that 200-day down, longer term downtrend to contend with. So, of course, still not out of the woods.
And if as you're looking at this from a technical perspective, as long as we don't take out the low of the follow through day, game on. The uptrend is still intact, and it will be intact. Ideally, what we were hoping, if you take a look at the reversal day yesterday, Wes and I were talking about, man, if we would just come back to the 50-day, that'd give us an opportunity to buy the stocks that we want to. And that's where, that would certainly be another opportunity if the market would sell off here, come into the 50-day, don't violate the follow through day, and don't have a distribution day too quickly here. So that would be the ideal situation in terms of adding more exposure, not going higher, but having the market pull back a little bit.
Yeah, pull back on lower volume would be great. I mean, this is a huge, this was a huge support day. I think this day is also huge support. So you've got, two kind of, and we close right here, right? So I mean, it should be a very important level. I think that low, like you mentioned. Okay, and so with our Stan Weinstein cycle work, we've got the 30-week moving average, and his measure of trend is being above or below the 30-week moving average. So on a long-term trend basis, kind of like we're bumping up on the 200-day. Here we are bumping up on this 30-week average, and when you want to see it close 2 weeks above that, so to consider a potential trend change there. Okay, and we talked a little bit before about the breadth of the market, so seeing some promising improvements here. So we're here at above 80% of stocks in the S&P 500 above their 50-day. We got faked out right in the August rally. Obviously you have to sustain this level now for the market to continue its trend. We were looking back at how this happened in 2020, 2021, right? And this is of course there are pullbacks in this, but you reach and you stay at that 80% plus level for a year and a half or so before things start to deteriorate and the internals weakened and the market narrowed. But This is, it's promising, right? It's great. We'd love to see it stay that way. And here's the S&P 500 percent of stocks above the 200-day. So still some more room to go to sustain that uptrend, but you can't deny it. We have some improvement potentially here in this. NASDAQ not quite seeing the same breadth like we mentioned. Only 54% of stocks above the 50-day, so not as much participation in the technology names right now. And then on the 200-day, looking at the NASDAQ, we've got 34% or so. It's kind of bumping up at that same level we did in August. And if this rally is going to sustain itself, it's going to continue to march higher. And it is some encouraging breadth that we're seeing. This is sort of telling the same thing. There's a pickup in breadth. We want to see the advanced decline line of the S&P 500 make new highs. Make new highs while the indexes are making lower highs. That will be a positive divergence there. So we're looking for that. And then the NASDAQ, really hasn't shown the same improvement in the advanced decline line. So similar. I mean, just another indicator on breadth, kind of telling the same story of the NASDAQ versus the S&P here. This is something we've been watching, right? It's hard to make money when there aren't stocks making new highs. We've seen the absolute number of new highs pick up, right? So that's been nice throughout October and into November. And on the NASDAQ here, this is a NASDAQ number. The net new highs have not quite turned positive. But we are seeing a pickup in the absolute number. If you look at some other indicators that are more encompassing of, I think, all exchanges, you might have seen some very, very modest net new high numbers the last several days, last 4 days. But just the NASDAQ, we haven't seen that. This is a longer term chart, just to again remind us in context. How prolonged this has been, where we just have not seen any stocks making new highs. Now it's been 1 year anniversary, I think, of the NASDAQ peaking. Just occurred, I believe, or actually that will occur. I think it's the 22nd of the NASDAQ, or the 22nd of November. So 1 week from today, we'll have a great anniversary of the peak, the good times. And then even looking further back, 20 years, just to put the carnage in context. 0809 was kind of similar, right? This was a year plus of the market just getting washed out with new lows. I think I think that early in the year, everyone was hesitant to compare it. Don't be sensational. But the longer this goes, the more you feel like it could result in something like that, or there are just more and more comparisons that seem accurate to it. Okay, and here's the McClellan oscillator, just an overbought, oversold oscillator. So we are overbought on this indicator. So that is we are looking for a pullback. We would like to dip our toe a little bit more in on any low volume weakness. Okay, the VIX here, we've been wanting a spike, right? But we still not getting a spike. We see volatility trending down over the last month. Kind of a wide ranging day, with the PPI, obviously, the market rally at the beginning, pushing it down, and these two missiles, which I don't know much about, but that hit Poland, and all of a sudden the VIX takes off. We are looking. We would think there would be a spike. We'd like to see capitulation, so we can buy with two fists, but we have not seen that. And this VIX could continue to get pushed lower and lower for the time being, while the market rallies for a few more percentage points. Yeah. And just to look at the VIX longer term, this is 5 years, highlighting the other spikes in the recent past. And just in 2022, haven't seen, huge spikes in that. Okay. And then the active asset manager exposure. This is what we look at to see how long active managers are out there. We're at 53% according to the latest survey. So super low, just what is that, 8 weeks ago or so. Getting more exposure as we might expect, as the market moves up. So this is, I don't know, this is kind of a no man's land to me, right? It doesn't really say much at 53%. Where you obviously want to look more at extremes. I'm not sure what to read into this, but just, there's still a lot of, it's been a consistent period of pretty low exposure to, people are not willing to get aggressive in this market still. Okay, and then looking at the bull bear sentiment, the bulls in the top panel here, and the bears, this red line in the bottom panel. Bears continue to outpace or outnumber the bulls. The ultimate bearishness hit 60%. Everyone on Twitter was talking about the last time it hit 60%. I don't remember when it was now, but at extreme level, 60% of bears. That was an extreme level, and it indicated that we were pretty close to a short-term low at that point in time when you get to a level like that. But here's a look at the net number, right? So bulls minus bears. So right here, clearly we've had that negative bearish sentiment on a net basis, where we have bears 22% higher than the bulls based on this AAII survey. And again, the comparison of just the length and the grind of this survey, where it's just comparable to this thick red bar of constant pessimism for a year and a half in 08 and 09. And so yeah, we're coming up on a year. We'd like to think that we're closer to the end of this than the beginning, right? At this point, I don't know what to make of a 3-year bear market and nobody's bearish, but so be it. It's a survey. And more tangible things, right, that we look at, put call ratio, similar to the VIX, right? We're looking for that gauge of fear. We're looking for spikes in fear. We saw that the 2 latest bear market spikes up at 1.4 on this ratio. This is a 5-day put to call ratio. So yeah, there's not a lot of fear right here at this point in time. But we were looking at this equity put call ratio. This is, I guess I don't know the intricacies of why this in particular might be different, but you do see this rising, upward trend of the last year in equity put to call ratio. You're actually kind of getting close, relatively more close to this, these other spikes here. Okay, and a few more slides to get through here, but other things we're looking at, and again, these slides will be sent out to you if you guys want to take a look. This is just something we put together every month, but this is the high yield credit spreads. So an index of credit spreads, indicating credit risk, right? So we've come down, we're consolidating. It's not nothing extreme has happened. We'll see. I don't know what FTX will mean for things, right? No idea if that's actually a huge deal or not, right? It's tens of billions of dollars that have disappeared. So you might think that's a big deal, but nothing indicated in the market about that, or at least in this spread. Yeah, in longer term, we're elevated. It's not like it's alarming. I thought that this was something that the Fed would be watching to use as their gauge of market's working. That's what he likes to say, right? Market, as long as markets are working, everything's fine. You know, I assumed that if these blew out as they sort of did here in June and July, that they would slow the pace. That's not the case. We'll see if it picks up again, or if, you know, we can just slowly get through this. Okay, we put this chart in. This is the iShares MSCI All World Index. Just to give us some context, this is global, right? This is a global recession, so it's a global equity bear market. Yeah, you know, as you would expect, when the largest, you know, market in the world, the U.S., is in a bear market, you know, there are larger effects everywhere else. And I think, you know, it's interesting to see that, you know, every other country is sort of at that, you know, they're below their pre-COVID highs, whereas the U.S. markets still have not gotten to that level, right? They're still, I don't know, I can't remember, 20% off those levels still, but after the bounce. So just a reminder, this is everywhere. Yeah, growth versus value. This has been the story of the year, right? Oil stocks that are difficult to trade because, you know, they're commodities and, you know, they're cyclical, and, you know, pricing will eventually go away. You know, it's hard. You just have to make a call on how sustainable pricing is, and who really knows. That's a very difficult thing to do. But this, you know, growth versus value has just not been in favor, right? It's been all about value this year. All right, and Bitcoin, you know, Bitcoin chart. I'm assuming everyone's heard the news. So, you know, panic selling, customer deposits frozen, right? Some money disappearing from exchanges and everything. So, you know, I thought that this would be a capitulation moment. This could be too, but I'm sure it's a little nerve-wracking to try to hold anything like that, or buy that falling knife. But still, you can see Ethereum really holding up better. You know, that's just continued to be almost as much of the story. And I'd be interested in seeing what the market cap actually. I don't know the market cap of these two anymore, but I'm wondering if Bitcoin has potential to actually surpass it, or if Ethereum has potential to surpass it at some point with this action.
And we're totally unclear where this goes, because we don't know how you can value it, you know, other than supply and demand. And but let me just say that we've all heard the saying, buy when there's blood in the streets. There's certainly blood in the streets. Mm-hmm. And that volume capitulation, both on Ethereum and Bitcoin, it would not surprise me if that marked the entire low, mm-hmm. you know, in the decline, and we just saw it because of the FTX blow up. And FTX, that was I believe the second largest exchange where Bitcoin and crypto is traded, and it went from $32 billion to zero overnight in one day. And so that has certainly shook up all the owners of, you know, of crypto across the world. Across the world, and many hedge funds were in there. John Tudor Jones, among many celebrity investors and so forth, that lost all their money.
Yeah, and you know, so I guess something to think about. Maybe you look at Coinbase. I don't know if they're obviously going to take share. I mean, there has to be a trusted exchange. And side note, anecdote, I also got a notification today, or an advertisement, I think on Instagram, about Fidelity adding in crypto trading on the platform, and they said, like, you know, sign up for early access. Because I think there was someone else that did that a few months ago. Do you remember? I don't know, but
No.
Okay. But anyways, I thought that was interesting because, you know, Fidelity absolutely will be trusted, more than this than the black box of FTX. Okay, and gold. So, we're just monitoring this asset class. It's not one that has, like, I feel like, enough volatility to get too excited about, but up or down. But dollar down, rates down, gold up. That is kind of what we, that inverse relationship has held true this year. So just something we're noticing there. And like we said, dollar down, right? So huge dollar down move, kind of perpetuating the move up in equities. And just a look at crude, off significantly from the highs, but it's, it seems to have stabilized in this 80 to 90 range for the last few months. I know there's a lot of, there's fears of demand destruction, but it has held firm here, and I think the equities themselves, right, the actual oil stocks, the like ConocoPhillips and Oxy, have all kind of set up recently too. So maybe they'll be leading this, the oil price higher. Okay, and like we mentioned earlier too, bonds, long dated bonds, these should start working, right? I feel like it's kind of a heads you win, tails you win situation. I don't know if that's not exactly the phrase, but if inflation slows, this should come down. If growth slows, or this should go up. If growth slows, this should go up. So it's kind of like, I don't know, it feels like a win-win scenario for some long dated bonds, if you think inflation's peaked, and even if you think growth is slowing.
And we also pointed out before this, the old 60-40 asset mix, 60% equities, 40% bonds. That was in this year. This is the worst performance in 100 years. So, just reverting back to the mean, I think you can make the case based on inflation dropping, based on a recession opportunity, that you've seen the low in that portfolio asset mix.
Yep. Okay, and then was our last look. We always look at this. This is just junk bonds, right? So another look at credit risk, and another big bear market bounce potentially, but this is just another thing, guys, that we like to monitor, and for just as a signal of overall health. So and that would be everything.
Thank you, Wes. Do I have charge of the cursor again?
Yeah, if you share.
Okay. Share screen. Let's pull this over. Okay, is everyone looking at MarketSmith? Are we keyed in on MarketSmith?
Yes. And
okay,
sorry,
good.
one quick thing. I see a few people have added in their email addresses. I'm just going to drop the link one more time. Instead, this is definitely the best way, just to click on that link in the chat box to key in your email address there. Thank you.
And let's take a short 5-minute break before we talk about individual stocks. But I saw some information in the meeting chat room, Wes, that Stan Weinstein, I've heard him both say, of course, in his book, Profiting from Bull and Bear Markets, he uses the 30-week, but I have seen him talk about the 200-day as well. And remember Mark Minervini's trend template, for you to be in a stage 2 uptrend, he believes that the S&P, the 200-day moving average must be in an uptrend for at least a month. So keep that in mind. So let's take a 5-minute break, and then we'll come back, and then we'll talk about individual stocks and see if we can identify some new leaders.
If I
Okay, you guys ready to get started? Does everyone hear me? Do you hear me okay?
Yeah, we can hear you. Let's get started.
Okay.
Yep, good.
Okay, good. Okay, guys, I think many of you tune in for this part of the presentation where we're trying to identify the potential market leaders. And what I'm going to do is take you through. I'm going to take you through about 10 or 15 stocks and charts, and then we'll pull up and discuss any of these stocks at length as I go through these, and also we'll go through individual stocks. The presentation normally ends at 9 p.m., but Wes and I will stay on probably as long as as long as there's an interest. Many times, the program goes on another hour or so. So just wanted to give you a heads up, but feel free to sign out at 10 and at 9 p.m.
Hey, Roy,
Yes.
sorry to disturb. This is Ronak. So is there going to be recording and slides that will be available? I mean,
Yeah,
and when are they?
We'll have these available for you in the next 1 to 2 days.
All right. Thank you.
Okay, you're welcome. Okay, let's take a look. Let's get flat. Let's get right to it. So these are what's showing up on our screens. And again, these aren't per se recommendations. You must do your own research, but I wanted to show you what we've identified. And we want to show you some like a strategy in terms of, well, where do you buy these stocks? You have to be careful that you don't buy extended stocks. So we're looking for companies that reported a great quarter and the stock acted favorably to the quarter. So Wingstop is one that we have small positions in, and I think 5 stocks now, but we want to get larger in this name, but it's extended. See how it's extended above the 10-day. So it's 4.2%. If you're trying to limit your loss to only 8%, it's, you don't want to buy here and be immediately down 4% just on a moderate pullback. For that matter, a pullback to the 21-day would be 9.8%. And you don't want to really double up either. So it's all about buying it on the pullback and having somewhat of a cushion. So if these stocks are going to be market leaders, they're going to go up for, true market leaders go up for 6 to 8 quarters, not just 10 days, not just 30 days, but they go up for, 94 weeks typically. But this is showing itself. They had a great quarter fueled by a sellout of their new chicken sandwich. You can see the stock is very close to making 52-week highs. So that's why we have it in the portfolio. And you can see it broke above the pivot recently, but it's we're looking at adding to this, on a pullback in a congestion area. In that same group, you've got Texas Roadhouse, TXRH. It's, in the restaurant business, it doesn't have quite as good of a chart pattern. You can see how volatile this has been. And we are going to look probably before we end the presentation tonight. You can see stocks, the tremendous volatility that has occurred in Eli Lilly, Veritas, NBIX, and so forth. There's just tremendous volatility. These are just very difficult. These are very difficult to trade and to establish a position in. That's why you need to buy these stocks on the, on the pullback. And we're really looking at buying stocks above the 10-day and the 21-day. And if it's at the 50-day, we're, those are questionable situations. You want to buy stocks and firm up trends coming out of the bear market, not something that necessarily at the 50-day or the 200-day. 2 other leaders, of course, are Enphase, ENPH, which has perhaps the best numbers out there. And notice the volatility, and notice the fundamental numbers. Earnings were up 108% last quarter. You've got triple-digit earnings, almost triple-digit revenue growth. The stock's got a 98 relative strength, near a breakout. And it tried to break out 2 days ago and then came all the way back in. Didn't close great today. It just needs to build the right side. And this is one that we're, for any of these sides that we're talking about, we would like to have 5% positions in these, but you've got to just see if it's going to work. We're dipping our toe in just to get feedback, and see, because the new market leaders, they're going to be making new highs. So this hasn't made a 52-week high yet. It's been basing for 4 months. So this is one certainly that should be on your radar screen. First Solar is another. This has been one of the strongest stocks since it broke out and had a 10%, 300% move on July 28th, where the stock was up more than 10% in a day. It was up 15% in the day, and volume was up 374%. In a strong bull market, guys, you can have many stocks that do this. They break out. You can have a whole plethora. They're going to break out, and you're going to be locked out. Look how nicely this stock traded, before it violated, the 10-day, and then you had the break here and then the move back up. So, now it's getting, it's going through a short congestion, but, it's somewhat extended. So it's extended from the 10-day 5.6%. And that could happen, that can happen just in a whipsaw, in a moment, in a day. And so you have to be careful that you don't buy it extended, because you don't want to be down 5.6% and nothing wrong with the position. Nothing would be wrong with this position until it breaks that 21-day. But we would like to buy on a pullback if the market has a congestion and pulls back to the 21-day. That's 10.3%. So, if you could buy it there at the 21-day, establish an initial position, and then press it as the stock goes, builds a base, builds this right-hand side of the base. This is came back too fast. It's a faulty breakout right here, but time can change things. I would like to see it just come in, for a few days, come back down to the 150 area, and which is $9 from where it is now, and then start adding the position back. We did buy a stock today, Shoals, that broke out, didn't close particularly good, but the stock was up 10% today. It was up 21.94%. And it's a solar stock in the same group. Solar's a leading group. And so we initiated a position here. As long as this stock doesn't take out today's low, then we would feel comfortable adding to this position, taking out today's high. But you had tremendous accumulation. This was on an earnings beat too, by the way. And notice the earnings in 2022 over here on the left side of the table. Earnings are going to be, they're 32% this year, and they're going to be up 121%. So this is right in the middle of that Inflation Reduction Act. So, and these are new companies. So this is how new leadership evolves, or how it begins. And when you have institutional ownership, and institutional buying that comes in, heavy volume, and with nice price increasing. In that same group is this Array Technologies. They make the devices so that you can tilt the solar panels at different times for maximum capability. And it did break a down trend line today, and it's got the same type of great numbers that Shoals has. You can see earnings were 300% last quarter, 173% revenue growth. So you had triple-digit earnings, triple-digit revenue growth. And this is what you should be screening for with the relative strength of 98. It's about to go into new high territory. But a lot of these breakouts have been failing, stocks that are breaking these downtrend lines. I can show you tons of these that have been failing. So the market environment's not quite right yet. But notice the earnings estimates over here on the left side of the panel. Earnings are up 750% this year and 185% next year. And what we like about companies like this is no one knows about them. You know, while everyone's trying to trade Microsoft, Google, Amazon, Apple, Netflix for the bounce, these are the stocks that can go up, that can double and triple. You know, but it's not going to happen overnight. But they are major beneficiaries of the Inflation Reduction Act. There are a couple of semiconductors that we have our eyes on. This is what we think is one of the leading ones. Notice this downtrend line, how a month ago, it broke the downtrend line and you got faked out. And now you have this nice double bottom, the low end, the next low end, and then, you know, this double bottom pattern with a retest. And now notice it's just moved, see, over the last 5 or 6 days. So by no means is this getting away at all, but it just needs to build the base. So we'd like to see this stock just consolidate and then take out the high of 76, 78. If it would come in to the 10-day and establish a little trading range there, the 10-day is 69.33. So for like 70 to 75 on a pullback, you know, if it came into the 70, that seems like a reasonable place to initiate a small position and then just see if you can get some traction. And ideally, a tactic would be buy the stock on the pullback to the 10-day. If it goes to the 21-day, that would be a very faulty pullback buy. That's too far. But if this stock just establishes a bottom here at the 10-day, and then it takes out the high, you know, in the next couple of weeks, then that's one that you can really press because it's the leading semiconductor stock, and they're in the I think it's gallium carbide or gallium, or it's not a typical silicon chip wafer that they specialize in. A lot of the chips that these guys use, they are in EV vehicles. But notice what's got our attention is that strong earnings, strong revenues, and, you know, great numbers this year. Earnings are up 78%. We don't look at PEs, but it's certainly trading cheaply. You know, if you want to look at it from evaluate it from an EBITDA level, you know, it's truly trading cheaply. But it's notice again, if you're following your charts and doing your screens, these are all going to show up. They're going to pop up like in the next 5 to 10 days. You know, if the confirmed rally is going to have legs. So, you know, this was not buyable until just a couple of days ago, coming back above that downtrend line. And so we have plenty of time to get on board. And what you do not want to do is have a whole portfolio of these and the market reverses and you lose 10% of your capital. Global Foundries is a domestic foundry company that are going to be beneficiaries of the semiconductor incentives to produce semiconductors here in the United States. You can notice the big bars of blue. So you've got big bars of blue. That's accumulation. It's a recent IPO. There's not a lot of overhead. They came in with earnings of 999% 5 days ago. So this is the type of powerful earnings momentum that you're looking for stocks that double and triple. We think that this has great prospects ahead of it. But notice it's up, you know, from the last 5 out of 6 days. But the 10-day, the pullback on the 10-day is 8.2%. So you don't want to come in here with we talk about just buying a 1% position in this because it took you out that 65.96 area, but we're just so cognizant of the market. This is extended, so it's extended. It's not buying exactly right. And what we're dedicated to do right here is, first of all, maintain total discipline and not buy extended stocks, but we want to buy these stocks on pullbacks. And we would hope we get a pullback in technology. And these are the ones that we're looking at adding. PI came out. They had a great quarter, and you guys do see my screen, correct?
Yes.
Yes.
Okay, it's not showing up. It's not outlining over here. So okay, so this stock PI closed poorly today, but notice the break where it had, again, that pattern that I always look for in the beginning of a new bull market. Stocks that are up big, particularly those that are breaking out to 52-week highs. This right here is your hunting ground. This is your fishing pond. This is what the next new leaders look like technically. And many on Wall Street have never heard of these companies before. You know, many of them are they can be smaller, mid cap, and we can see money flowing out of the large cap tech into companies like this. So this is a very healthy thing to happen, as money's got to find a place somewhere, and it's going to find its place in the companies that are growing the most rapidly. So notice the earnings report, 50% earnings growth last quarter, 51% revenue growth. And remember in CanSlim, of course, the acronym, that what we're looking for minimum is 25% earnings growth. And, you know, over the last couple of quarters in the last year, and 25% revenue growth as well. The market has changed somewhat over the last 30 years where revenues are more important than earnings have been. And that's why you see stocks like Amazon and Google, they didn't have any earnings for years, but yet they had spectacular performance because of their organic growth and their revenue growth. We're going to see potentially that happen in the biotech space as well. You're going to have companies that have products, and we'll look at a couple of those as well later, that don't necessarily have earnings growth yet, but they do have revenue growth. So you have to be very careful in the biotech area as well, because the ones, if they're moving up because they're getting a phase 1 or phase 2, they haven't been necessarily approved. And when the FDA pulls their approval or disses it, then they go down typically 50% in a day. So you got to be real careful. We're avoiding the biotechs that do not have earnings. But this is a nice little congestion, but it's just extended. It didn't close well. But this is one, if you're sitting there watching your screen, see 109.82, 109.82 is the 10-day. That would be a reasonable place to initiate. And we think the current environment is such that the 10-day to the 21-day is what, depending on what type of pullback we get, that's where you want to initiate positions and then give it time, and then see if you can gain some traction where you can end up taking a 5% position. But if you would have bought this on the pullback today, see at 119.79, then you'd be down $5. So that's exactly what you're trying to avoid. But this is on our radar screen. They're sold out. They're in the RFID area, and they're sold out. The demand is there, but they're also producing the product. It's different from having someone not do the numbers because they can't get the product, and therefore they don't have the financial results. So you want to make sure they've got the financial results. If you got, this is a name from the past for me, years and years and years ago. Let me see. Yeah, in this 2000 area, this was one of my biggest winners 20 years ago. And this is Taser. So they changed their name. It's the numbers are very consistent. They've developed more than just the stun gun. They've got body cameras. They're storing documentation online on the cloud for law enforcement agencies across the country. And so this is sort of like a razor blade approach. They've got consistent numbers. You're not going to have Portland Police Department shut down once they move everything to their process, or or Boston or Chicago or any of those companies. But look how extended it is. But this is where the leadership comes from. So notice that where earnings were down 49%, they were profitable. And I haven't read the earnings report, but it's how the stock reacts on the news that's important. It's not necessarily what the report is, but obviously, if you're screening these things, you can see it's got 98 relative strength, new high. This is one of the leading stocks in the market, and it's just getting going. And if you take a look monthly, it's going sideways, see, for a couple of years. And so it's knocking on the door of the breakout. So, these great winning stocks, if you get stocks that double, this is going to have to go from 200 to 400, in the next market run, but it's well on its way of doing something that's unusual. And you can see how tight there has been no selling. And sometimes when you get the leading stock in the market, it doesn't go to the 10-day. It just uses the 5-day moving average the whole way up. So we want to buy it, but it's just too extended here. But if it consolidates and gives you an opportunity, as the 10-day catches up, that would be an ideal place of putting in your stop. And if you've got a small position, we're trying to keep our stops around 8%. This has hit our books, and if for all of you that follow Kathy Donnelly and E. Bobbick and Eric Crow and those guys, the lifestyle trade, there's going to be some of these IPOs that have gotten hammered. They're going to be potential new leaders. And this is one, we were looking at it yesterday, but we didn't want to go through we didn't want to buy it before the PPI came out in case there was a disappointment. But what we like about it are the numbers. Earnings this year are going to be $1.36. And they've got a full suite of payment processing technology that they're having great success in, as you can clearly see by the numbers. And earnings are going to be 54% next year. So it's a mid-cap stock, and it's breaking above. This is really, we view this as an early entry. It's breaking above the 200-day. The 200 days bottoming and starting to turn up. Relative strength is improving, and it's broken above all these pivot points. So the pivot point, this downtrend line happened 2 days ago, and we clearly saw it. We just didn't, we didn't take a position ahead of the PPI today, but it's taking out this resistance. And if it'll just come back in, say you have a little pullback, it's going up, 4, 5, 1, 2, 3, 4, 5, 6 straight days. And see the EMA, the 10-day, it's 15%. So you don't want to load the boat here. but it's something that you buy on a pullback and just see it will give you an opportunity, but it's turning up. Institutions are buying the stock, and you can see you got 357 funds in the position. Along the same line as well, guys, we took a small position in Toast. There was pretty much an inside day today. It's the same concept. Look at the revenue growth. So they've got great revenue growth, and they provide the technology. They've got point of sales, plus they're the guys when you go into a restaurant and they hand you the tablet and you can place all your orders on the tablet, and you can pay your bill there on the tablet as well. They provide that technology, and I'm seeing their technology being adopted here in Charlotte all over the city. So you can see that you've got also A+ funds. T. Rowe Price has got a 26 million share position. They own 2% of the company. You can see more and more funds like Fidelity and other A+ rated growth funds that are going to presumably take a position. So this is an unusual. This is an unusual setup. It's a lifestyle cycle type of trade, but it's an early entry. It's above the 200-day. You've got all the averages, the 10 days above the 21-day, 21 days above the 50. But this is the type of setup that if it works, you can take a small position here and then press it, taking out 23. So, you get it, see how the stock trades over the next, few days, and then establish, your position, have a full position, taking out that 23 pivot. That would be a low risk way. And notice the institutional buying. These 3 days, that's huge institutional buying. And we did have some selling today. So, you can watch that one carefully. Halo, HALO, that's of course on our screens. And if you go back and look at the 2020 bottom, and a lot of these bottoms, your stocks were, you'd be surprised that you would see how many stocks were not buyable at the market bottom. But quickly, this is Wes and I were talking about this. This is truly a basketball underwater. And notice it was unbuyable, 1, 2, 3, 4, 5. That stock's really not buyable. It looks like it's rolling over, coming down to the 21-day, and then it explodes on their earnings report. So we just caught it, there's the earnings report, and then it moves quickly to new high territory. So earnings were 35%, revenues up 80%. And this is what's got our attention is earnings next year on the left side of the screen. Earnings are going to be up 102% next year. So you can have triple digit numbers. So this is where the leaders, this is where you want to be looking. You want to look at these stocks that have triple digit numbers. Uber did have a good report, but there's a good report. It's also, it can potentially work as well. You've got a lot of A+ funds in this, and it reacted good to the number and pulled back. So you want to see the stocks that act good at the number and then consolidate. And then when you come back and take out that high, this was a buy technically today. And so this is on, this stock hasn't done anything for a long period of time either, but they are going to break even next year. It's been a period of loss after loss, but they're going to break even. And remember Meta and Facebook that stock was in a major downtrend until they finally turned the corner of profitability. So that's what's going on there. A Mobileye, MBLY, they make the technology, the sensing technology for autonomous driving, brand new IPO. So a brand new IPO, but they have not reported earnings yet. And yesterday's close was very poor, but it broke out. You had this IPO base. It's in the advanced phase. So you can't buy this stock in front of the number, but if there's a good response to the number, this might be a new leader as well. So they need to, the market knows and the company knows that they're going to have a great reported results, or they'll just sell right into it. So it's going to be important to see what institutions start to buy it, where do they start to buy it. But that's on our watch list because of the action. And Elf, got a couple more, and then we'll turn it over to you guys. Elf Beauty has been in this nice uptrend. Of course, they're in the cosmetics area. They had a really good report a week ago. It's been in this nice uptrend, and earnings up 33% this year, 9% next year. It would be it'd be a recession play, just like Costco or Dollar General, BJ's Wholesale, and companies like that. If indeed we are in a recession or we go into a recession. This SMCI should be on all of your watch list. And again, notice how unbuyable this was, but now it's buyable. See, now it's got through all-time high. It's been very, very choppy, but it's extended. So if you see this stock, for example, come back down to the 80 area, and you can't buy too much where you're uncomfortable. If you see the stock's down 7, and you're just and it's making you very uncomfortable, you just bought too much. So by no means would I take a 5 or 10% initial position, on a pullback buy, but that would be a place to get it on the sheets and then identify and then let the stock prove itself. Notice the earnings report, earnings up 490%, revenues up 79%, and you've got that triple-digit earnings growth the last 3 quarters. And it acted great. Some of the biggest winners, by the way, that Bill shared with me before is that if you want to see like 3 straight quarters of a good reaction to the earnings reports, in many cases that helps you narrow it down. You can see you had a great report, reaction, that report, the next report, and then the next report. So they make a lot of devices for printers and servers and so forth. And another leader, Sanmina. So there's Sanmina. There's the breakout on earnings. That's the action that you're wanting to see. So this is, notice that, I'm bringing you to like the potential new leaders out there. They're extended, but again, this is only a few weeks in the midst of a stock that can potentially run for, a year and a half or so. So, these are the ones that we're identifying, and the stocks just have to prove themselves. If they don't prove themselves, if there's a bad quarter or the momentum changes, then you just simply kick it out. But that's how we're approaching it. This Celsius reported their quarter. They had a very poor result. They had a big charge. They had a big charge because they canceled their distribution agreements with their prior contractor, and they've gone with Pepsi, as you all know. But this stock has great revenue numbers that are accelerating. These numbers are going to only get larger as Pepsi rolls out their product mix. So but 3 days ago, see, before the number, it wasn't viable. So we owned this stock in the last month, sold it probably breaking the 50-day, and we're looking at re-entering it. Shockwave, which was one of the leading stocks, and this was a crowded trade. Of course, they make the device to that uses a sound pulsation to clear calcified arteries. And this was just, you had a very poor reaction to the earnings report. The report wasn't that bad, and we did some digging around. They own, and we read some analyst reports as well, they own about 3% of the market. And the reports that we in this type of market that the devices are used for, and the reports that we've written, the analysts are estimating that it'll be 15 to 30% of the market. So they have a long runway ahead. But look at the volatility, and this has had one up day. And it's running into resistance. It just needs it's going to need time, but it's certainly an innovative device with very poor results. And look how they sold it into the breakout. I mean, they sold right into it. Then if you were long the stock, if you bought it on the breakout of the downtrend line, you immediately got kicked out in one day. So that's how difficult the market environment has been. Same thing with Lantheus, the last stock I'll go over. They really had a decent report in their product, and they gave excellent guidance as well, but they sold into the report. You can see they sold right into it. And we actually had a small position that we sold, I think, that day, as the stock was rolling over. And then, and that was the reaction to earnings wasn't what we were looking for. But you have a lot of A+ funds in here, so this, if this stock will turn the 10-day cross the 21-day, and it firm up and get back above the declining 50-day, then it might be a viable candidate moving forward. So guys, that's all that I had. That's about 20 something. Oh, one more. Dexcom, DXCM, the insulin company. There's a reaction to earnings. And this is exactly what you'd like to see. So it breaks higher, and then there's the pullback to right here. So it's giving you've got a lot of institutions in this stock. And, they've got the, they, along with Insulet, PODD, are the two leaders that also had great results to the numbers. So you want to see a great response to the number, a pullback, and this would be on our buy list as well if it gets tight here on this right side. Notice earnings are going to be up 71% this year and 188% next year. Great earnings. So stick with the stocks that have earnings, screen for those. And again, realize that this market is not getting away from any of us. It looked like death 2 weeks ago. None of these stocks are viable, but they're going to show up probably in the next few weeks. So that's all that I had in terms of the stocks that I had prepared for you guys. And with that, I'll turn it over to you guys.
Hey, Roy, it's Michael.
Hey, Michael.
Hey, two stocks, if you don't mind. First one is Dicom, DY, and then Crocs, COX. It was on our list along with DGII and COFD. So the telecom infrastructure area, it was, it's moving up. It's 51 out of 197. And look at where it broke the downtrend line and then rolled over. So it's, you've got this somewhat, you've got this double top. the numbers were great. We're definitely watching the stock. We did not buy the stock, and earnings are in 7 days. So it's really a crapshoot.
Yeah.
It's a crapshoot. It's on our screens. You had great action and then it rolled over. But that's what happens. It's not buyable here. It's below the 10-day, below the 21-day, below the 50-day, going to the 200, and it's definitely a crapshoot.
Okay.
And Crocs. I mean, Crocs looks much better. Look at what I like about it is the response to the number, Michael.
Yeah.
So, and I guess Crocs, they're reinventing themselves again. And, look at that nice base on the weekly where it just broke out last week. So, if this is the real deal, you're going to see this stock go up here from 100 to, come up here and, go to 150, we'll see, as long as they continue to grow. You had really good accumulation. You've got, you got funds in it, and you've got an A+ fund right there in it. And it's in this, instead of it being in this stage 4 decline, Michael,
Yep.
it was in this stage 1 base, and now, it's in a stage 2 uptrend. So this is a stock that looks good on a pullback, and obviously you have it. So congratulations. That was a great buy when you bought it down here.
Yeah, thanks. Okay, thanks a lot.
What's the stock?
No, I said thank you.
Oh, you're welcome.
Hey, Rai, quick question.
Yes.
So the stocks that you've discussed, these are all like, showing a good growth and a good solid quarter results, handpicked, or is it something that you ran a screen and generated?
Well, they all showed up on screens that I ran.
Mhm.
And, I run a lot of screens, stocks that I'm looking at the 52-week high list, and this screen was very bare today. So that's one of the things that I looked at.
Mhm.
I look at this every day to see if there's new merchandise. And look at this. This is the 52-week high list. There's not a lot of good quality stocks. I mean, there's Diamondback, an energy stock. There's Tenneco. Amcor this is interesting because it's in the same area as Flextronics and Jabil Circuits. And so that's on the list here. But, you got a few energy companies. You don't have tremendous growth companies. And again, we're really not looking at the energy stocks that are so vulnerable to the price of oil.
Yep.
But, I saw this, and so that led me to pull this up. And, this is it, so this is a screen I run, the 52-week high. And notice, see, 1, 2, 3, 4, 5, 6 days ago, this was totally not buyable, just totally a horrible chart. And now it's made a 52-week chart. So it's out of the gates quickly. So, this has got our attention, along with AEHR in the same group. But this is a tiny company that only did $10 million in sales last quarter. So I'm not comfortable with the fundamentals here. It's just too small, but it is getting out of the gate. I do know some money managers that are initiating positions here, but look, they only have 50 funds, so tiny. We could never put a client in something like that. But we run the top 200 composite, that stocks that are up 10% in price, and volumes up 300% to get those breakouts. So we run that. This SE, see, this is an example of and that's how we got shows. We bought shows off of this screen today, and we wanted to initiate a position, see what happens, and we followed the group. And so the action is exactly what you're looking for. Look at this C Limited up 36%. but it was this stock. This is something that's been down. Look, it's down 82. No, this is before it's up 26%. It was down 82%. You could never buy this stock. I mean, we couldn't, in a firm downtrend, down 80, so obviously was down 90%, and it's up 26% in a day. That's the kind of action that's been happening in these low quality stocks. So do not, whatever you do, don't have FOMO. If this turns into a rip snoring bull market, then you're going to have plenty of these stocks that break out to new highs, set up, and then it's going to be an easy dollar environment. So don't press your luck. Just that's what I would advise everyone. Dip your toe in. Buy a few stocks, see if they work, see if you can get some traction, and then add to them. But we certainly identified a number that can work. I mean, you only need 4 or 5 stocks that double to make your whole year. And we'd like to have a 10% position in 10 stocks and get 3 of them that double, and the rest is just lagniappe. And right now, we were just trying to identify, well, what 10 are possible. This 99, this 99 earnings per share rank and 99 relative strength rank. David Ryan, and I followed him for 30 years, as in the industry, and in conversations that I've had with him 30 years ago, when I was first learning the markets, because an MBA certainly doesn't adequately teach you how to make money in the market. It just gives you some fundamental background criteria that enhances your knowledge base, but it really doesn't teach you, well, how do you make money in the market? You make money in the market by studying prior patterns, looking at prior analogies, trying to identify what leading stocks, the characteristics of leading stocks today, and based on what they looked like, based on the past market winners in the past, and just translating that. And David told me that when he won the U.S. Investment Championship in the mid 80s, and he won 3 straight years, he said he found some of his biggest winners were stocks that had a 99 earnings per share rank and a 99 earnings per share relative strength rank. And so I'm always looking at this. And so this was that DGII that I mentioned. There's that SMCI that we've already looked at. And so let's take a look at that DGII. See, and we're looking at, Wes and I were looking at buying this stock, but look at how thin it is. Average volume, 400,000. It's only trading $16 million. And really, that would be pushing it for the liquidity that we would look at. But it's a 99.99, and it's going to 52-week highs. This should definitely be on an individual's watch list. So it's in that computer networking group like ANET. And ANET's really the leader, and we want to buy this, but it's hitting the downtrend line. A lot of these downtrend lines have failed. So we want to buy it at the 10-day, and that's 4.1% if it'll pull in a little bit. But that's it. So that's in the group. And then this is a biotech stock, CPRX. And you had this is really called a power play, where it goes from 6 to 12 in a brief period of time, sideways, makes a new high, and then it gets clobbered, and now it's building again the right side of the base. But this kind of volatility would be something that you'd certainly get shaken out. So we run a lot of these screens. Yeah, go ahead.
Can you have a look at PSTG, please?
Yeah, that looks really good. So this would that's Pure Storage. I think that looks outstanding. So earnings are going to be 50% this year. 12% next year. No, the analysts have no idea, by the way, where these numbers or what they're going to be. We have a lot, we have a lot of economic activity and a lot of time before us, so, the earnings estimates are almost immaterial looking at a year, but you want to see you want to see certainly a positive trend. But I think this stock, you can see where I had a downtrend line drawn. It didn't really break it. Then it rolled over and it's come back. So you have this massive cup and then this handle. And then you had big volume right there. So as it's trying to break out of the pivot, and then it's squatting now, it's coming back into the pivot. I think it looks outstanding. You've got 600 funds. You've got Fidelity in there. So you've got confirmation. And this is really useful, guys, for you conducting your research. All you really need to know is, okay, you've got Fidelity's best analysts. They're all taking a position. Or a T. Rowe Price or Columbia, or, there's many A+ growth funds. And that gives you confirmation. And notice where the mutual fund ownership has actually increased as also. So you've got a nice, the stock's trying to break out. What's it look like on the weekly? So it's definitely, you've got some overhead there, but it's getting tight in here. And this is something, I think it looks great. I would definitely, that's on our watch list.
How about ALGM? That's a kind of it's a little extended right now, but it's an active little semi.
It looks, it's building, it's coming back. See, and that's what's interesting is, how, again, I keep reminding myself and you that, as listeners, that this just started picking up. It got above you had that early entry where the 10 days above the 21-day crossing the 50-day. Then you had that pivot. Look at where the volume came in, and you've got to be on top of the individual company for you to be able to buy it down here. So it would have hit some volume screens if you're following it, but we run the relative strength is actually firming up pretty nicely as well. And what's it look like on the weekly? So, not great, but it's going up 1, 2, 3, 4, 5, 6 straight weeks. So
I think you need to build a handle here, a little bit of a handle.
Yeah.
Provide an entry point,
Yep. Yeah. And remember those handles, see the 10-day, you'd like an ideal handle would be like 10 to 15%. The 21 days, 13%. That's a little bit too much. That changed the look of the pattern. But I'd love to see this thing handle and just go sideways. And then you could buy a little bit on the pullback and then press it, taking out that pivot of 30, if it goes sideways for a couple of weeks. And, didn't have a great close today, but it's had this massive move. The stock's up, 50%. Yeah, I think it's definitely with the volume there. I think it definitely looks worthy of, owning it on the pullback or going sideways. So we'll definitely watch it with you.
Thank you.
You're welcome.
Hey, Roy.
Yes.
Can you look at Harmony Bioscience? Pulled back pretty hard today. I'm not sure. Do you consider that a bad egg?
No, it's on our buy list, but and you can see I have this little downtrend line. The numbers, the numbers are really good. And we've already tried it before. We bought this stock earlier in the year before, but you had an outside day to the downside. That's not a great look, but we've had rotation. See out. You're having rotation. Vertex Pharmaceuticals is the same thing. We actually owned a company, NBIX. We'll get to that in a second. And we sold it like 3 days ago because Vertex and Regeneron were getting hit. So I consider this is a perfect setup. So earnings were up 132%, great revenue growth. And look at the acceleration. Earnings are going to be up to 66% this year. And it had a great reaction to the earnings. This was just rotation. You got mutual funds in there, but there's the rotation. By no means do I consider it a bad egg. I didn't know if there was any news on it, but it's in the context of the group rotation that took place today. So if it'll firm up, you don't want to see it violate the 21-day by 2 days. But if it'll come down here and hold the 21-day and snap back, and if it snaps back quicker than later, then it's definitely would be on my buy list. But there's the volatility. You're welcome. There's the volatility seed that we had on NBIX, and we had a tiny position, 1%. We sold it right there because Vertex was rolling over. And so NBIX had biotech with numbers. Earnings are going to be up 87% next year. It's at a 52-week high. Great relative strength. Only a few weeks ago, the relative strength line's at a new high. You got A+ funds in it. But there's the action. So if this will set up, this also is the 14th ranked industry group. But look how you just got stopped out, so this is the volatility that's been so prevalent in the market. And when this Vertex was down $22 right there on no news. So you're going sideways, and then you just get blasted. And then it came all the way back. And when this was down 22, Regeneron was getting hit as well. It was so in the context of how the market is trading, and that's why it's been a market that's been untradeable literally for almost the whole year with this volatility.
Got it. Okay. One more question here. I noticed a lot of the stocks that you're looking at, the index, what's that up there? The 1 second. It says 14 out of 197. A lot of them were like below 60. How much weight do you put on that, considering
I put a lot of weight. I mean, normally in that you normally want to be in the top 40 industry groups. And I mean, I've seen people say, I've seen, hedge fund managers that I collaborate with. I've seen them say the top 5 industry groups, but that's just too focused, and particularly when it's in all the same industry groups. Well, if we look at Market Smith Growth 250, you can see the industry groups there. But I normally like to be in the top 40 industry groups, or the industry groups that are moving up. Rarely, or you can find great leadership in the lower ranked industry groups. I avoid that just in almost in all cases. So industry groups are very important. And here's the Market Growth 250. This is a proprietary screen, of course, that's got over 30 screens. Mike Webster put this together years ago with probably Justin Nielsen or Chris Gessel, probably. years ago. And it's primary, so it's ranked, so this ranks the top 300 stocks as terms of being the most attractive. And they use industry group strength as one of the primary inputs. So you can see here, you've got oil and gas, transport, see all this. And these are not typically growth stocks. And so there's that Sanmina that we talked about with their competition, Flextronics, Plexus, they're in the 6th industry group. So we do look at this quite a bit to see if we can uncover like new leaders. And there's the Interactive Broker, and this is let me show you how choppy it's been. So this is the number 9. We were looking at this. There's Interactive Brokers and LPLA, which was leading. So this was, so we're watching this carefully, and this is just abnormal action. This is just a poor market reaction. And we don't know if that was FTX. We have no idea why this rode over, but that's certainly, everyone got kicked out of this, and they had a great quarter. And LPLA was on our buy list, and look at it go down 20% in 4 days. So this is not the type of market environment that you want to see in a brand new bull market. You've got a bull market stock, but then you had a very poor reaction, and it had just about everything that we were looking for in terms of the numbers and industry ownership as well. That that's just market rotation, and you really don't want to see that market rotation.
Right. One last stock, CEG. It's a pretty new stock.
Is that
not sure if you look. CEG.
PEG?
No, C as in Charlie, Echo, Greg.
Oh yeah. So boy, this is Wes and I were looking at this, and we were playing a couple of these earlier. Playing them, trying to get our teeth in here, and so they're in all aspects of the renewable energy market, and they're going to be, there's presumably going to be primary recipients of the Act, Inflation Reduction Act. And look how the stock reacted to the earnings. And this stock really never gave you a really valid opportunity to get in. So there it is at 60, and it really never came in. Stock's acting great. It's a big company. Look at the revenues, and we like this, doing 65, 11, 16, $20 billion in revenues, and the market cap's only 30 billion. So the price sale is really low. It's definitely a leading stock, great relative strength. Earnings are out of the way. You didn't have a great reaction to the number, but it's building this right side of the base. It definitely, if it can go sideways, taking this pivot out of 96.29 or taking this pivot out would be a place to buy. I'm assuming you own it, right? Or are you just looking at it?
I do not. I've been watching it.
I think it looks great. So no, it's getting real tight, so it may come in. It's going to go pretty quickly, though. I mean, right now it's going to break down to the 50-day, which that wouldn't make me excited. But if it can just go sit in here and go sideways and then take that 96.29 out, I think that would be a great setup. Earnings next year are going to be up 49%. Nobody knows about who this company is. it's off the radar. You got to look at the institutions in it.
Yeah.
I'll put that back on our watch list again. EE is in that sort of, that's the natural gas still, that energy alternative solutions, and EE had our attention. Look at the earnings and revenues for this company. And someone, I guarantee you 95% of people on Wall Street have no idea who this company is. But look at these numbers: 803 million versus 192. Earnings up 990%. But look at the downtrend line where it broke the downtrend line and then failed. And I'm sure we own the stock back here. I'm sure I know we owned the stock at one point, either early in that June area and got stopped out, or we got stopped out right down there with the position. It doesn't have quite as good a chart as that CEG that you mentioned, however. But the numbers are certainly there.
Yeah, so considering this is the industry at 174 over 197, and that one's at like above 50.
Yeah, not great. Yeah.
Okay. Well, thank you.
You're welcome. Let me pull up the industry groups. Daily. Okay, so industry groups, 3-month price change today, and rank. I want to get industry group rank. Sort that. So this is where this is the leading industry groups, and you can see the column here, they're ranked. So that gives you quite a bit of stocks to that you're looking for. There's the oil and gas royalty trust. There's the retail, like you've got AutoZone and O'Reilly's, which is defensive. If we go into a recession, that's why these have, that's why these are predictable. Retail department stores are actually number 3 right now. There's solar. There's that contract manufacturing. Machinery farms such as Deere and Caterpillar has moved up. Look at this. It's moved up from 86 in rank 3 months ago to now 8. So I watch this to see, well, who's moving up? By the time they get to number 1, they've already had a major move, but there's computer networking that's gone from 39 to 10. There's biotech that's gone the other way. And so this is, this will give you a lot of nuances to see, well, actually who's moving up and what time frame. But I do like to primarily focus on the top 40 industry groups normally.
Hey, Roy.
Yes.
Thoughts on 9 NINE?
Okay. NINE.
Yes, sir.
Man, a great move from low price stock. Not a lot of liquidity, traded $10 million a day. Looks like you had a great earnings report right there. The stock reacted positively to the earnings report. Really a pretty large number here. You've got a great earnings per share gain. And, again, it's in the oil and gas area. Smaller company, 331 million. Let me just say, you've got to be careful because energy stocks have been leading for a while, And when you have the second tier names, when you see these second tier names double, double or triple, that's normally the end of the cycle. So just keep that in mind. You don't have a lot of institutions in here, mutual funds in it. You got this big move. So be aware that, you can turn around and this stock can be at the 21-day. That's down 52%, in 2 days. So it's in a great uptrend. It's not viable in my view here based on what I just, said. The last ones that are making new highs, the speculative ones are the ones, the lollygaggers, late to the party. But if you own it, congratulations. And, you haven't had any obvious sell signals. But, this stock, if this stock breaks the 10-day, you've got to be on your toes.
Copy that. Thanks.
Okay.
Hey, Roy.
Yes.
Thanks for doing this. This is my first time attending this, and I loved every bit of it. I have a question on ALB. What do you make
Yeah.
of the action today? I mean, it came down all the way to its breakout of 280 and closed in the higher range, though.
Yeah.
What do you make of
So
that action? Yeah.
I don't like it. We were looking at buying it. It was on our buy list yesterday, and we thought it was extended. Well, it was extended. It came, and this is what I don't like about it. It was down huge on their earnings, and so the numbers are fantastic. The numbers are fantastic. I think they tightened up guidance a little bit. And of course, as everyone knows, this is the lithium play. And news came out today that that some EV players in China were cutting back their lithium exposure. And they made note that lithium prices were at the highest level in history, and they expected lithium prices to go down, and it's a commodity. So this is why, so it has to do with the price of lithium. We have no idea where lithium is going to go, but it was a leading stock, but you have action like that. And I actually own a little bit of this stock personally, and I sold it on the open down like 25 or something like that. I had a very small position, but we were looking at buying it for clients, but that's not action that we want to see. And so you got kicked out of a couple of times, see how the volatility. And so that's really, it's coming back. It's at the 50-day going sideways. And then they rug pull you. Then it comes all the way back. Then it's earnings and it's down 22. Then it comes all the way back. It's just action that it's very difficult to feel confident in. But we thought that it had everything that you want. You've got the institutions in there. It's at a 52-week high. The numbers are incredible. And, but it's had this this characteristic of just being very volatile. So if you have if you bought this stock at 308, you got kicked out of it, today with the 15% loss. And, so there's the breakout where you could have bought it right there, going through the 308-24 pivot, and then you get it rug pulled. So what would be very frustrating is that if this stock comes back and makes new highs, we've tried this stock a couple of times, and its cousin, of course, is LTHM.
Hey, Roy, it's
Yeah.
it's Amit. I think this is partly because of rotation after the CPI reversal.
Yes.
And due to the lower bond yields as well as dollar, there's been a rotation temporarily from these new leaders at 52-week high into like higher risk stocks. So, things like you talked about SE which is down 82% and jumps 26%, so people are booking profit on these stocks and then trying to make some money out of the, beaten down stocks.
But these had growth numbers. So, I mean, they had tremendous growth numbers. So you could say it's a cyclical because it's in the chemical area as well. But this was going up because they're the world's supplier along with SQM of lithium. That was the narrative there. And certainly the rotation, I think that article that came out of China today, that fueled the drop. That was the drop. Whether or not it's sustainable or not, we'll find out if people like Fidelity jump on board. But there's your rotation out of the stocks that you're talking about. This is the real rotation there's Hershey, where one was hiding out, a 27 PE on a company that's growing 3%. There's the rotation. That's the danger of buying these consumer, the XLP and these consumer stocks. But it's good for, when you see money come out of here and then it finds a home in a lot of these new leading stocks that we're talking about. That's why I'm somewhat unsure of in the biotech stocks is what is that, is this rotation? And I'm not quite sure, but you got some wild and woolly action, but are these coming down because of rotation, because they were presumed to be defensive? I'm not quite sure, I mean, there's Lilly with, they have those two great drugs they're working on, and they had solid numbers, but it's only growing 1%. And so that's not really attractive from a growth standpoint.
Roy, this is Tim Colbank calling.
Yeah, hi, Jim.
I got a question for you. When you made your trade with Celsius, how do you go about what you look for when you do your post-trade analysis?
Well, first of all, I looked to see if I was right or not, on it. And this is, we were giving this stock some latitude. Again, this stock had a great breakout. Getting above. This is what got our attention. That breakout on volume right there. So really a pocket pivot going through right off the 10-day, and then the moving action, the sideways action, and we actually own this. We were giving it some latitude. It was, it was below the 50-day, but we thought the numbers were going to be spectacular. But as we got closer to the earnings report, we couldn't hang with the stock. So we had maybe a 1% position a month ago, and we didn't put it back on. And then, post analysis would be, I mean, we're not in the position, and we were kicked out of the position at some point in the last 30 days or so, with a modest loss. And, we were looking at buying this back, coming back over the 50-day. But again, we didn't want to go through the PPI news. So now we need to look to see if where do we buy it? And the setup from post analysis is after the trade. And we got kicked out of the stock at some point, but it was a different, it was a different entry. It was probably an undercut and rally position where we put it on and then got kicked out of it. So it's been 6 weeks. They don't all work, of course. In a really good market environment, I mean, in a big bull market, you should have about 70% winners. When the market environment is it's rolling, but we haven't had, the growth stocks peaked February of 2021. And we've been in a really bad growth market for growth stocks for 18 months now. So, it used to be, well, I write everything down. I mean, everything that we do, I write it down in a notebook every single day. I don't know if you guys can see that, but every single day I keep it in a notebook, and I've been doing this for 30 years. And I don't really, there's so much activity. I mean, in my personal account, I don't really have to do a post analysis because, I make thousands of trades in a year, but, we're trying, we want to have less turnover. We're trying to position build and get on the next leaders in the next bull market. That's really how you make most of your money. It's most of your money. It's being in things like Zoom and Upstart and Affirm and Teladoc and Livongo and Datadog, CrowdStrike, when they're in that, when they had those major growth periods. All the Cathie Wood stocks, everything was easy. It really should have been, should have been a warning when, every stock that Cathie Woods bought peaked, February of 2021. Right there. I mean, that's where the growth market peaked. That's where it really peaked. And then last year was very challenging in growth. And then he just simply got the rollover there. So growth has been out of favor for a year and a half. And that's something to keep in mind. Now, these stocks are going to never come back. So you don't want to, but, you could have, it's bounced huge off the bottom, but, this is down 66% now after bouncing, 10%. Just to have a fund down 70%, that's really unheard of. This is almost going to the way of comparing this to the FTX debacle where the platform went under. So it depends on how, it depends on how active you are, I would say, to answer your question, and how experienced or unexperienced. I mean, I've made so many mistakes over my career that it's easy to see, well, I just made a mistake. Yeah, I don't have to spend a lot of time on it and dwell on it. I just try to take my losses to not lose more than 2% of equity, in a trade. So that means if you had 10%, at worst case scenario, I would never let something go down 20% in price that I had a 10% position in. So I know that in terms of the post analysis would be, well, where did you take your loss? But if you can keep your losses, that's what, if we buy 10 stocks and with a 1% position, just to dip your toe in, all 10 can go down 8% and you lose only 1% of your capital. That's really good risk control as you're trying to get your feet underneath you.
All right, thank you. I mean, I made the same trade. I mean, I did everything right on the sell end, but I just realized I bought it incorrectly. I bought it too soon. So,
where did you buy it, by the way?
I bought it on the 23rd when it broke above the, I think, what's that, the 21 day?
Yeah.
88.
The 23rd, right?
Yes.
Right in there. Yeah, that would be, I mean, for me, if I'm sitting there and I'm seeing it reverse down there and I'm following the stock, that's really a perfect buy, I think, in terms of, it's not a VCP pattern, but, you're guessing at the bottom of a base. And I think that's a perfect buy. Now, buying it right there, it took out the prior day's high. didn't close great, but then you were immediately profitable the next day on the 25th. And it would, from a trading perspective, a lot of times what I'll do is, and I can't move millions and millions and millions of dollars like this, but you can put 100 grand in something easy. And, you move your stop up to break even, and then you would have gotten kicked out at break even, when it came back down, right in there. And, nothing ventured, nothing gained, depending on, how you want to, what your objective is on the trade and how much profit you had too. So if you had, you had $10 of profit right there, so you could have sold half and backstopped the rest at break even. Then you would have made money on the whole position. I think that's.
Yeah, I sold it on the 3rd of November on when it broke below that prior day's low. I got out right there at 84.
And let me share with you just my experience. And, Mark Minervini is a friend of Wes and mine. And, so we talk occasionally. And we're also subscribers to his service. It really facilitates and assists and enhances what we do as well. But he's always selling strength. Like if he gets a profit of just a few percent, he's selling half. And I know for a fact, particularly if he's got a real large position in something, he'll sell something up 5% and then backstop the rest and just see what it turns into. And I prefer I'm trying to make 20% or more on the trade, on the position. And I'm trying to find something that can double or triple. And so, if you're, and typically my stops are just like yours, where if you're not selling the strength, your equity curve is always coming down to a degree based on where your stops are getting hit. And I know that's very frustrating. I know that's very frustrating. But you'll never get the stocks that, that go up, that double if you don't have a trailing stop. So it's all a matter of your temperament and, and your psychology and the way that you trade. I think that's important, and we're all different. That's one of those questions that you can't ask for everyone. You can't tell everyone, well, this is the way you should do it. There's all kinds of ways to do it. But I think you executed great. It's just a stock, it just ran out of gas and you took your profit and then it got kicked out. And then you have to decide, what do you do here? We're looking at the stock again. So but it's hard to buy something up 8% in a day. Well, we're not, because it comes into the 10-day and then you're saying, oh, shoot, what do I do now? But it's on our watch list again. I think it's going to be a big stock, but it was crowded too. Everybody's in it.
Right.
Everybody's talking about it.
Thank you. So, that helps. Thank you.
Great. You're welcome.
Hey, Roy, can you go back to SHLS?
Yes.
Let's say tomorrow it goes through the 2847 pivot again. Would you consider that a buy point, or would you wait for it to take out the $30 mark?
I probably, if it comes back and reclaims the pivot, I might add a little bit. To it, but I am going to press it. I'm up in it a little bit. Not much. I'm probably up in it 50 cents. And I was up in it, a couple of dollars, at the high, it hit 30. Yeah. But so I don't want it to get away from me. So if it takes out the low, and it may take out the low to shake you out. And if it takes out the low, I'll probably sell it.
Yeah.
you know, if it takes out the low, I don't want it to take out the low, but you know, it's going to be, I don't have a lot, you know, I don't have a lot in it, but I do, you know, I've got a 1% position in it for clients, but I have more in it personally. But this might be one of these stocks that goes from 30 to 40, you know, and easy by the next earnings period, Joseph.
Yeah, yeah.
So, I mean, it's right on my list. I don't want it to take out, like, if you take a look at First Solar, see First Solar back when it broke out, it's hard to see right there. You know, it got sideways a couple, it didn't take out the low of the breakout day. Let me see. And the big ones are going to make it hard. Yeah. See where it, on First Solar, it did not take out. So ideally, that shows gets quiet, and we're going to press it taking out 30.
Yeah.
I mean, you know, we can be, you know, we're going to be wrong. You know, we could be wrong, but you know, I'm going to buy it. And I'm going to, you know, I'm going to have I'll buy it pretty heavily if it, you know, if it takes out today's high, you know, if it powers through that. Because you don't want to be late to the party, then you know, then you're, you know, then you miss your opportunity to have somewhat of, you know, any type of a cushion. That's a great question. You know, that's exactly what I am studying and looking for, to see if it recaptures that pivot.
Yeah, I guess it just depends what you want to do. I guess you could try the pivot or just wait till 30. I guess it's just a matter of how much risk you want to do.
Yeah. I mean, I'd like to have a 10% position. Maybe I've got a 10% position in it.
Because like this is in the solar group, so if solar goes, this should theoretically go. I mean, First Solar just seems, I'm not in First Solar, I would love to be, but like, you know, I'm not chasing it here.
Yeah.
So like SHLS would seem like a better bet to if it pushed out that 30 mark, you know what I mean? Or if First Solar comes back to 145, yeah, that would be great. I'd take that all day.
But then, you know, then it's been hanging around the 10-day the whole time. Then if it goes to the 21-day, it's going to be scary, you know?
Yeah.
Like you're going to be, you know, you're going to say, well, why is this darn thing at the, you know, you want it to, the breakouts, you don't want this thing to break out. That would be a faulty breakout. If it breaks out and comes all the way to the 21-day, the way it was before. And then, so, I mean, it's definitely, I mean, I'm sure if we're not in it, we're going to be nibbling, dipping our toe in or something like that. I hate to use those two words, but.
Like, I tried a similar setup to I tried the MEDP. It had an earnings gap, and I tried buying it through the next day. I bought it through actually the close of the prior day, and then it went, you know, all the way up and it squatted. And I just cut it because I didn't like the way it looked. I just said, you know, it squatted so hard, I didn't want to stick around, and I would have.
I bought it, Joseph. I bought it personally right there. The second day.
Yeah.
And got kicked out. You know, didn't close great, and then it came all the way in. But I just, you know, you don't like that action there for, you know, this action all the way, it came all the way back to the 10. But see, this didn't violate the low either.
That's true.
See, you know, so it did not violate the low. And, but
yeah,
you know,
if you bought it on the test of the low, you're sitting pretty right now.
Yeah.
Tough call.
You know what this is called? You know what kind of pattern this is called, don't you?
I have no idea. I call it a squat. I don't know.
I call it squirrely.
That's funny.
Like, gee whiz, this is squirrely.
Yeah. But yeah, that kind of reminds me of the SA. Like if SHLS pushes through tomorrow, like, I'm gonna buy it. I'm gonna give it a shot. You know?
Hey, Roy, would it be possible to cover ENPH action today? I mean, it kind of went up and sold out, right?
Yeah, what's the action? What was the stock?
ENPH?
Oh, yeah, we
ENPH.
talked about it. You know, it's got great numbers, didn't close great. But if it, if it'll come in here and just go sideways, build this right side of the base, come into the, to the 10-day, you don't want to just overpay, but this company has dynamic growth prospects. So, this is one of our top 5, I think, best opportunities so far, but it's got to break through to the high, and it's got to hang on to the new high and not have not sell breaking into a high the way that it sold off before. So this has got all the ingredients that you're looking for a potential market leader. Great numbers this year, next year, great guidance, a great runway because of the Inflation Reduction Act. And this is where the leadership should come from. The 5th ranked industry group. This could be the #1 industry group and last for a year, but it's got to prove itself. So we bought it. We bought a 1% position in it today. Just so it's on our sheets, we can watch it, and then we'll see if we can manipulate into a bigger position.
Yeah, makes sense. But I mean, my question is, it has such a wide range of action, right? Every day, it's not like a tightening. Do you look for a tightening pattern, or is it like going to be like this?
Well, I'm looking for something that that has a great uptrend, a beginning of an uptrend, like First Solar at the beginning of the run, like this action here after it reported the quarter. That is, in a bull market, this is what you were looking for, a move like that, except you want to see a sustained move that lasts for months. And sometimes they don't last that long and they blow off to the upside. Other times they last a longer period of time. But there's a stock that went up 40%, 40% in 2 months. So in a very tight manner, in a very uptrend, proper pullback, new uptrend, pullbacks, and so forth. So we're trying to find these stocks that just have that sweet spot, and you're never at risk once you buy the stock. So when you see you getting 5 or 10 stocks like this, then you can start pressing your positions. And we think it's observe, orient, look at the data and act. We think that's what you need to be doing your preparation for, to see if we can buy some of these stocks that break to new highs and that continue to go higher. And there's going to be many of these that set up if we're in a new market environment, a new uptrend. I guarantee you that it's setting up when this bull market begins and the bear market ends. And we think that a number of these potential true market leaders, they'll never see their lows again. But there are going to be plenty of other opportunities that are going to present themselves. A triple-digit year is coming, guys. It's just a matter of navigating through the bear market and being patient, and following the macro position to see if we have a profit recession, or if it's going to be contained. But remember, Powell only a week ago said we're not close to pausing. And Wes and I were discussing about the 94 to 95 market, where we had the bear market, the Fed paused, and then the market continued to go higher. And you hear all the people on TV that are talking about the Fed pivot and yada yada. I think rates are going to be higher for longer. It's going to put pressure on companies. The Fed wants to see the employment numbers jump. So he wants to see unemployment rise. He wants to see layoffs. He wants to see a cooling economy where wage inflation is checked. He doesn't want the market to rally hard here. That's not in his playbook, because you have the wealth effect means people are going to spend more money. That's going to be inflationary. He doesn't want that. And whether or not he can control it or not, we'll see. But I don't think he's delighted to see the biggest 2-day rally Thursday and Friday in 14 years.
Thanks, Roy.
Hey, Roy, can we take a look at Brothers?
Yes.
BROS, Dutch Brothers?
Some of these are going to turn in to great opportunities, I think. So this is, of course, so the coffee company, most of their coffee firm, the coffee locations are drive-through, I believe. And it's got decent numbers. They've changed their policy of leasing and company-owned businesses and franchising. So it kind of it has hurt their earnings short term, but it's going to give them a smoother release of their earnings in the future. They're going to be more consistent, a smoother, more consistent stream of earnings in the future. So it's one of these IPOs, and some of these IPOs, and it could be DoorDash, it could be Uber, it could be Brothers. These can turn into dynamic companies, and it's got poor relative strength now, but it's on our watch list, and it continues to be. But it's in this downtrending 200-day that's capturing the stock. It needs to, it's still in a downtrend. But you had a good reaction to earnings. That's the first thing that you want to see. And you actually had to look at that earnings report right there. So you had a great reaction to the earnings, came all the way down. Now it's building this base. And you've got that 38.95 pivot right there. So, if it goes sideways a little bit, I guess this is still in a stage 1 sideways market. It needs to get above the 200-day to be in stage 2. So I don't think it's buyable here, but it's buyable above 38.95 going above the 200-day. And I think it's a well-run. I think it's a well-run establishment. I've heard a lot of positive things about it.
Hey, Roy, can you look at 2 shippers, International Seaways, INSW, and Sting Scorpio tankers?
Man, what a ride! What a ride this has been on. Broke out at 25, and it's getting toppy. They sold into it. Look at the distribution right there. The last 3 out of the last 4 days. So that's selling. That's institutional selling there. You need to protect your profit in it. You've had this amazing run, and it's up. Stocks, this has had a phenomenal move. I would expect it to come in. That's had this big, that's pretty climactic. And there at the top, it was 24% above the 50-day and 82% above the 200-day. And that's notable. So, I don't like it as a buy here. It needs to really consolidate, build a new base. It's extended, but it's been a rip-roaring, fabulous stock if you were in it. And Scorpion is
STNG.
STNG. It's been the same kind of move, 11 to 50, huge selling, and huge selling. That's that would have my attention. It's up. Here it got real choppy around the 50-day, and earnings were great. Of course, in the shippers, that could be peak earnings. And if we go back, there was another shipper. We'll pull up. Who was it from Israel? Zim. We'll pull that up in a second. But notice the numbers. See, 313, 429. That's probably peak numbers. You had a stock that's up fourfold, and it's up fourfold. Stocks peak on peak numbers, and there's the best earnings report. I'd be really careful with this one because there's the move 11 to 50, same kind of thing. I don't think it, by no means would I buy. Look at the earnings, $11 this year. Earnings going to be down 27% next year. You've got to be careful because you'll get a situation like that Zim, which was the leading. See, this was the leading shipper in the whole market back here. And, a lot of us were playing, or, we were trying Zim, and there were a couple others that I'm trying to remember. Joseph will probably know. And there's earnings. Look, there's peak earnings. There's 900%. Then $14, $14.19 to 11, and that's the March quarter. See peak earnings right there. Peak earnings right there. And the stock was telling you, you had this poor action, the sell off, the double top, to see if it was going to go higher, and then it just came totally unglued, 68 to 22.
Okay,
So
thanks for pointing that out.
I would be real careful with those two. Those two tremendous winners. Congratulations on those two stocks. Don't hang around or just protect yourself. You can always write covered calls on those positions too, deep in the money to protect yourself if you really think that the industry's got a lot further to go.
So do you still think that Apple and Tesla, Microsoft are gonna hit their are going lower?
I do. I think they will. And this is what makes this interesting, is that you're going to have a decoupling. And it happens all the time. You're going to have a decoupling, and we knew that they were going to get the generals. All you had to do to make 20% last year is buy those stocks that you just mentioned. That's all you had to do. And it's not that easy. And, that load, that trade, that was so crowded. And, look at Tesla, 51 PE, but granted they have, pretty good numbers. But, everything that we see from Elon, if demand is off and so forth, there's a lot of issues there. And we're looking at that 50-month for being support. But, when these leading stocks turn over, and that 50-month right there is 155. So I think there's 50 more points of downside in Tesla from here, despite everything that's happened in the market in the last week. I think there's 50 points of downside in Tesla, and companies. There's Microsoft that bounced off the 50-day. And what remains to be seen, if we're in a recession, if we go into a recession like 2000, 2009, the end of 2008, and see where we came up. We came down to the 50 month the first time, and then you just rolled over in the next 6 months. So we're hitting the 50 month here on Microsoft. Business is not great. So if we bounce back here, your upside is limited by that 10-week. And, I think, you can come down there to that 2020, come down there for Microsoft, Google, bouncing off the 50 month, which is fine. And so it depends on, are we going to be in a recession? There's 2007 to 2009. And so this is a logical place for you to try to bounce. But if we have a profits recession, you're looking at right there. You're looking at it down another $20 from here, from today's close. And Apple, where everyone's been hiding, that 50 month is 107. So I'd say that 107 to 110 area is where, if business rolls over, just like in the recession of 2008 to 2009, you go to the 50 month in the world's greatest company, because it's also one of the most expensive companies at a 24 PE. And look at earnings next year, or this next year, earnings can grow at 2%.
Yeah, I think
That's
if we're in a recession, no one's gonna rush out to buy $1,000 phone.
Forever. I mean, that, I couldn't understand this move from the bottom to this rally there. And it's the same thing. And look how badly it closed. So people are selling right into that, where people are having FOMO buying the Qs. I think it's over for the Qs. I mean, I think we've made a secular top. I think it's gonna take years before you take out that high. And I think you're gonna have a rotation out of all these stocks. And when these things, they're not, it's gonna be a long time before their growth rate is reestablished. 1 year, 2 year, 3 year, took 4 years. I think it's going to take 4 years to make a new high in the Qs.
So
they're just not going to go anywhere. You don't have the growth, and they're over-owned, and you need time before, to come out of all that technology stuff and come, and replace that with new companies,
that's probably why, like, the IWM is outperforming the.
Yeah. And so, I mean, look at this. So the IWM and the diamonds as well, it's going to be interesting to see what happens. You're right up here where, people have FOMO, right? Where we're at the top of the trading band, where we could easily roll over. So you have to be very careful. You got to be very careful here. But the Qs aren't even close to the 200-day. That just shows you how weak those stocks are. And look at before the, this is just purely, the last 4 days, purely short covering. People aren't buying this because there's a lot of chasing. There's liquidity in those companies, but they're not going anywhere. And we've got bottoming action in all the garbage stocks that Wesley called. Bottoming action there, but so that is bottoming action. Then you get this follow-up action, but I don't think these are going anywhere. They're going to be trapped because of their valuation. The numbers on all these stocks are going to come down. Microsoft, Apple, Google, all the numbers are going to come down. And Wall Street is factoring in earnings of about $2. Earnings came in about 3% ex energy this quarter. And Hedgeye's predicting earnings to be down 5 to 10%. in the next 2 quarters with the profit recession. And so you're going to see these stocks get dumped because, if we have a profit recession, I think that's coming. I think the Fed at 4% interest rates, that's going to slow it down so much. Something's going to break in the economy.
What about Facebook, Meta?
It's same kind of bounce, but they're losing billions of dollars. It's just, I think it's a mistake. I think it's a mistake to buy something like this. I don't like it at all. You'll hear people on TV talk about free cash flow and all that kind of stuff. That's no, it's a stock that'll, it's can never come back. This is going to take years. So there's a trade in everything. See, from the bottom, if you bought it 2 weeks ago, you got a great trade. It could go right up there to the 50-day, but the Qs have been so weak that I wouldn't be surprised if it reverses tomorrow. And you got that little bounce. Once these stocks get trapped, and from a valuation standpoint, see, this is what you have to contend with. See, there's Zoom from $588 to $70. But look you got the rally. The stock's trading at a 19 PE, no earnings growth this year, down 27%, down 4% next year. You're paying more than a market multiple on something that's not growing. And so there's the risk that you come in here and you buy all these beaten up stocks like a Meta, and you're trapped. You're trapped with your capital, and these things can go sideways forever. They have to have a new products, and they have to reaccelerating their earnings, and you can see earnings down 22%, down 23%. After doing this for 3 decades, that is the major mistake that most people make, is trying to buy this stuff, thinking that it's cheap. I saw Josh Brown bought it right there on the break on the number, and it's a stage 4 decline. I have no idea how anyone that would purport to be a professional would buy something gapping down on a bad number on the biggest volume in its history, and you're buying it. That makes no sense.
You want to do the opposite when it's gapping up on its biggest volume in history.
Exactly. That's exactly what you want to do. See, Teladoc's the same thing. No earnings this year, no earnings next year, trapped. A great business model, but they just overpaid. They lost half of their valuation with the Livongo purchase, overpaid at the top, and it's going nowhere fast. And I guess that is the example that really is the example, if you want to, say dead money. And, any of these stocks, the garbage stuff bounced huge, but you have to be real careful. You have to be careful to not get trapped and not be able to take advantage of the opportunities when they present themselves. Let me see here. This on Market Smith, by the way, guys, just as a note, up there, you can put your alerts in, and you have the open stock ideas. So, you look at this daily, only 2 stocks broke out today. PS, they make tubing for oil wells and steel. So that broke out today. Lincoln Electric broke out. So run these screens to see if you're missing, to see if you miss anything. So these are great near pivots. So you have this chart pattern to help you identify the pattern, and run this near pivots so you can look at those recent breakouts. I do love this HALOs that's got that proprietary technology. And if it'll come into 52, that's setting up with that accumulation, great accumulation. This would be a really great idea with great numbers in the next year based on a great technology. So this, the screens turn over, guys, quickly. And, you have big turnover in the, in the IBD 50 as well. But some of the leaders, they're going to be on the IBD 50 list. It's just, there's such rotation there. But here's the IBD 50. And, we've talked about many of these stocks. This should be one of your go-to list in, in a bull market. There's that 99.99 on a couple of stocks. There's that SMCI. There's the MEDP. Many of us has followed that CCRN. That's the firm that for doctors and nurses. There's ENPH. You got some energy. There's that Harmony that was on the list. There's Wingstop. See, there's Taser, Axon Enterprise. In a good market, this is where your leaders are going to be. There's that PSTG we looked at earlier. PSTG. So this is, watch this. There's that Shoals that hit. That Atcore. There's that ON Semiconductor. This is, in my view, this is where you want to be observing and looking every day. You only need one stock with the 10% position to really get your feet underneath you and get it all back, and get two stocks. Boom, and you get the right ones. You get back. You got back the whole year. If you're down.
Roy, this is Tim again. I got a question for you. Looking at Halo, and I'm looking at Emerson Electronics.
Okay.
When stocks start building up that right side of the base, a lot of them have what David Ryan calls ants type of qualifications. If the volume is not there, even though stocks are still climbing up the right side of the base, is that really that important that he looks at?
I think it happens. You want to see, particularly on up days, but you just want, you're not going to have volume. This is huge volume. If this would, if we had ants, I think they're like 13 out of 15 straight up days.
Right.
And so there's 1, 2, 3, 4. Now, and by the way, and, David's work has shown that if you have something that's up 15 out of 17 days, something like that, that it goes much higher. And that's the whole point, is that, gee whiz, I'm thinking this stock is, overbought, but it will never come in. And that's just kind of one of the things that, that he noticed. And he's of course shared that with everyone. I think the initial volume breakout's the most important, but unless you have like a climactic run where it's the biggest weekly bar after the stock is up significantly, like say the stock's up 40 or 50%, in those 15 days, that would be climactic. But you know, it would just be deemed overbought, but not climactic if, you know, unless you have that widest bar. When you see something that has the widest bar of the upturn, you got to be careful that that's not, you know, and it being extended from the averages, that's not a climactic top. But you need to have, I mean, you want to see accumulation in that uptrend, but you're not going to, you can see down here. Yeah, see, this is a really pretty good example from the bottom. So you had that big volume break, the move. And of course, it's easier to see this after the fact. You know, that huge volume move off the bottom. And so you had an undercut and rally where it took out, you know, your buy point's 38.26 over here. There's your buy point. When it took out that 38.26 on the reversal. And then you have a move there. Starting to, if you want to start counting the day before, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. You had 10 out of 13 days, and the market went higher there. So, but you know, it's the market's been such that you haven't had more than average volume on many stocks. And now look at this, the last 3 days, tremendous volume above average. That's how you determine if the move is really just beginning or not. And that's been the character of this market. You know, we haven't not had big volume, but now you're starting to see volume come in some of these stocks, and you know that you haven't heard of. See, here's this Atcore building, you know, so building materials. Look at the volume start to come in now. There's, you know, and this is a safer way to safer place to make your entry once you see the volume come in than trying to guess the bottom.
Hey Roy, got a question. These past 2 years, has this been like the craziest kind of market environment? Like how fast, like we went from a COVID crash, to basically euphoria in like a year. And then now, you know, we're through this. I mean, this is my first like legit bear market that I've been through. And it feels like it's happened so fast. I was just wondering if you ever experienced like the market environment changing so rapidly.
It's the hardest market environment since the 2007, 2009 great financial crisis. It's the hardest market that, you know, and we just had a great market in 2020, but you had to be in right at the bottom, you know, in 2020 to take advantage of it. And that led to a great 2020. And then, you know, the peak in 2021 on growth was unusual. It's the hardest market that I've seen in a decade. And it's gonna get easier, but you know, but this is just it'll beat you up, you know, in terms of taking away your mental capital. It'll beat you up, you know, if you have too much of a drawdown. It's, you know, it's brutal. Hardest market that I've traded in years. 2015 was a real hard market too. We went sideways 2015 and 16. So you made no progress. And I've mentioned this many times, you know, you made no progress for 2 years, and then Square broke out at 17 in 2017. The early part of the year, and that launched a great 17 where everything went straight up, and they were all around you. You know, the stocks were all around you, and they, you know, you had a lockout rally, and that'll happen again. It's just very hardest market that I've seen in a decade, 15 years.
Definitely trying to well, I've been pretty patient through it all, but maybe ever since this bottom, I'm trying really hard to just like I'm not FOMOing, but it's like it's been hard to buy breakouts. Like only this rally right here has been like the junk. And then like you try to buy like a PI or something like that breaking out, and it just doesn't work, right? You know what I mean? So
you feel like you've forgotten how to make money.
yeah.
Like, gee whiz. I mean, I've been doing this 35 years, Ken. Man, how difficult can it be? It can be really difficult and wear you out.
Yeah, well, I guess the sun will come up soon and we'll be in a great bull market again. At least that's for sure.
It will be. And Mentor Vinny's struggling himself. He said he used 4 words that I can't say in public.
No worries.
But he thinks the market is pitiful. And that was one of the words he used.
Yeah.
And that's when you hear people like Mark Ritchie, that's one of the greatest traders alive too. He's down mid single digits this year. And Jim Ropel's down. Guys that I think the world of that have stood the test of time. Those are some of the best on the planet. And it's been brutal.
It's been an experience.
Yeah, it has been. Guys, I think I'm gonna call it a night. I'm just checking the chats to see if there's anything that I can answer before I sign off. I hope you guys got something that you learned tonight. Hope you can implement some of the things we talked about. I hope some of the stocks that we've identified work for you. And I wish everyone happy trading, great investing. And we will see you next month. And we'll send out the slide deck and the recorded message in the next day or so.
Hi, Roy.
Yes.
Sorry, I missed the beginning. So what do you think about this missile thing? Is it no issue or?
I was listening to the Pentagon today, and they did make a comment. So the market did sell off and went negative on the 2 missiles that exploded. But it came way back. I think it was probably an overreaction, but if they start, if they invade Poland, that's going to be a different story. But so far it could be just a misplaced missile attack that happened to go across the border.
I see. What about if Trump declare that he's going to run again? What would happen to the market?
I don't think anything. I mean, Congress is we talked about that earlier. We have a divided Congress, which is gridlock, and gridlock is good for the market. And I think what's going to happen, and from what I hear from all the pundits, Ron DeSantis is trying to maneuver to get into the election. I think he would be very good for the market. But I mean, Trump just creates chaos. So I think people were tired. People were tired of politicians on both sides that won't compromise and that are just looking out for their interest. I mean, I think people were tired of that if we would just get some good candidates. And I'd just like to have some good candidates. Okay, guys, that's all that I've got. I hope you guys have a great evening, and we'll see you soon.
Take care.
Thank you.
Thank you.
You're welcome, guys.
You're right.
Thank you.
Okay.